Section 4, we have what we call bid, ask, and spread with MT5 practical application. Objective. This section is to help you understand how currency prices are quoted in the forex market, what bid and ask prices mean, what spread is, and how to observe these values on MetaTrader 5. So let's go to A. What are bid and ask prices? When trading forex, you will always see two lines or two prices for every currency pair. We have the bid price. The bid price is the price at which the market or broker is willing to buy the base currency from you. We've already discussed what the base currency is. So bid price is the price at which the market or your broker is willing to buy the base currency from you. You sell at the bid price. 2, we have the ask price, also known as the offer price, the price at which the market is willing to sell the base currency to you. You buy at the ask price. I'll read it again. Ask price, also known as the offer price. This price, the price at which the market is willing to sell the base currency to you. So you buy at the ask price. Let's look at the diagram. When you look on the diagram, you can see we have the bid, which with a description that says the price a buyer is willing to pay for a stock. And we have on the right hand side the red, which is ask. That is the price a seller is willing to sell their shares. This is talking about stock. The same way, if we are talking about currency, you will have euro, USD, or euro here, and you have USD here. And the difference between them is what we call spread. When you go to the chart, which we'll be doing very soon, you can see two lines. We always have two lines. One is red and one is green, and there is some small space in between them. That is what we call spread. Okay, B, let's talk about spread. What is spread? The spread is the difference between the ask and the bid price. It represents the broker's profit. It's also influenced by market liquidity and volatility. Let me go on it again, or read it again. What is spread? The spread is the difference between the ask and the bid price. It represents the broker's profit and is also influenced by market liquidity and volatility. Sometimes when the market runs or moves very faster, you can see that the spread will open, especially when there is an economic news taking place. The price will move very faster, and that sometimes opens the spread, which we'll be discussing all that. Looking at the diagram, we have ask price and bid price. The ask price is the price at which you can buy an asset from the market maker, and the bid price is the price at which you can sell an asset to the market maker. If you check the prices, you can see at the ask price we have $101.00. When you come to the bid price, we have $100.00, and the difference between them is the $1 there, and that $1 represents the spread we are talking about, and that is mostly the market maker or your broker's profit whenever you open a trade. We'll be practically doing that so you see how it works on the charts. Some things to note. Tight spread is equal to lower trading cost, common in major pairs. Wide spread is equal to higher trading cost, common in exotic pairs or during high volatility. D. Keynotes. Spreads can be widened during major news events or low liquidity periods. Like I said earlier, spreads can be widened during major news events or low liquidity periods. 2. Some brokers offer fixed spreads. Some brokers offer fixed spreads, while others offer variable spreads, depending on market conditions. Understanding spread helps you estimate your cost per trade. So if you understand what spread is, it helps you to estimate what your cost is going to be whenever you open a trade. Because whenever you open a trade, until you are done paying for the spread, even if the market is heading in your favor, you will not make money. Conclusion: mastering bid, ask, and spread is essential for understanding trading costs and timing your entries and exits. With MT5, you can easily monitor these values and adapt your strategy for better risk and cost management. Section 5: Lot size and pips. So in this section, section 5, we are going to be talking about lot size and pips with MT5 practical application. This section is going to help you understand what a lot and a pip are in forex trading, how they relate to trade size and profit or loss, and how to apply this knowledge in MetaTrader 5, MT5. So let's come to A. What is a pip? A pip, percentage in point, is the smallest price movement in the exchange rate of a currency pair. A pip is also called percentage in point. So pip is the short form of percentage in point. It is the smallest price movement in the exchange rate of a currency pair. For most pairs, a pip is 0.0001, the fourth decimal place. So if you check, we have 0.001. The one there is what we call a pip. Example, Euro USD moves from 1.1050 to 1.1051. The pip here is equal to 1 pip, because if you should deduct 1.1050 from 1.1051, you will have 1 as your answer, and that is your pip. So whenever the price moves, it moves in pips. Some of you that you've been seeing others saying this strategy, or you are going to take your profit at, let's say, 10 pips, 100 pips, 30 pips, or 50 pips. This is exactly what they are trying to talk about. So if the price moves from 1 to 2, it becomes 2 pips. 2 to 3, 3 pips. Let's talk about the other one, which is for JPY pairs. A pip is 0.01, the second decimal place. So when it comes to JPY, that is the Japanese yen, it is the second decimal place. Let's look at the examples. We have USD moves from 1.10 to 10, which is 10, to 1.10 to 11. The pip here is equal to 1. When you deduct 110.10 from 110.11, you will have 1, and that 1 is your pip. I believe we all understand what a pip is now. You can see it explained in the diagram with different digits here, or numbers. B, we are going to be talking about a lot size. What is a lot size? This topic is equally important. Some of us don't even know what it is, but we jump into the market trying to make money. And this is one of the most important things you need to know before you even think about opening a trade. A lot size refers to the number of currency units you buy or sell in a trade. We have standard lot, which is equal to 100,000 units. We have mini lot, which is equal to 10,000 units. We have micro lot, which is equal to 1,000 units. And we have nano lot, which is equal to 100 units. Let's come to the diagram here. If we can all see the diagram, you can see we have lot size, we have standard, mini, micro, and nano. In front of that, the standard, we have 100,000, which comes with a volume of 1.00. We'll be learning on how to change that and how it affects our trade anytime we open. And we have the peak value. So 100,000 units, the volume is 1.00, and the price or the pip it represents is $10 per a pip. When it moves, when the price moves from a certain price to the next, the difference there is what we call pip. When you are using this kind of lot size, that is the standard lot size, when it moves just one, it costs $10. That's just one pip will cost you $10. So imagine if the price is going against you, just a move will make you lose $10. That's if you are using the standard lot. That is why when it comes to risk management, this is very, very important. When we come down to the mini lot, that one is 0.10, which is equal to $1 whenever the price moves a pip. So a pip is $1. That is the mini lot, which the value is 0.10. When we go to the micro, we have 0.01. The value is 0.10 pip. So when the price move a pip, that will cost you 0.10 pip or 0.10 cent. When it comes to the nano lot, which is not available on most brokers, that will cost you 0.1 cent per a pip. Most of the time, as a beginner, you start with the 0.1, which is the micro lot size, depending on the amount you have in your account. So your lot size determines how much money you can earn or lose per pip movement. Your lot size can determine how much money you can earn or lose per pip movement. Let's go to C. How lot size affects pip value. Here is a general idea. For standard USD quoted pairs, standard lot is equal to 1.0, which is equal to $10 per pip. Mini lot is equal to 0.1, which is equal to $1 per pip. Micro lot is 0.1 equal to 0.10 cent per a pip. The larger the lot, the greater the risk and the greater the potential reward. I will read that again. The larger the lot, the greater the risk and the greater the potential reward.